And you will give me a signal, Meghna, when to start.
Sure. We can start, Raja.
Great. Okay. Good. Good evening, everybody. Good morning, depending on the locations you're joining in. To be honest, it's a privilege to present this webinar and around SPACs. Well, I may say clearly the hottest topic on everybody's mind, on everybody's corporate banking firms, on what is a SPAC. Plethora of activity that has happened in the last 3 months in 2021, and in fact 2022 was called the year of SPACs. Uh, well, uh, uh, my name is Raja Lahiri. I'm a partner with Grant Thornton Bharat, and looking after the overseas listing practice for the firm. Uh, well, this is a topic that around overseas listing is something that we really were passionate to talk about it from last year. In fact, our India CEO Vishesh Chandiok was possibly the first one to comment on the opportunity of direct overseas listing from India, and of course we did a couple of webinars in November in terms of talking about why this is such an important opportunity for Indian corporates, and we also talked about the how, right? What does it mean for Indian corporate to getting listed in an overseas capital market? And we also said that it's a journey, it's not a destination, because there are various nuances, there are significant benefits, but of course there are significant liabilities as well. Well, today's conversation is really about SPACs, and if I may say that India is very much on the global stage with one of India's leading, if not the number one company in the renewable space, with Renew Power getting listed and getting merged with the SPAC in the US. And so it's a really an opportunity for us to really have an August panel to present in front of you. It's a 90-minute discussion, and what we'll try to do is to really cover as many aspects. From an audience perspective, there's a chat box. You can post your questions, give your comments. But in case we are not able to pick up all the questions, to the Grant Thornton email ID, you could send us your comments and questions. We will definitely try to get back to you. Well, moving to what is a SPAC, some of the key fundamentals of SPACs, right? And I'm sure there are various people who's already known about SPACs in various levels, but I thought it'd be important to just raise some of the ground rules. SPAC, right? What is a SPAC? It's a special purpose acquisition company, clearly created by a group of sponsors, very significantly experienced management team who's got experience in capital markets, in doing M&A, and really creating value for investors. So sponsor is the key. You form the SPAC and you raise capital from the capital market, but with a single agenda is to do acquisitions. Fundamentally, it is also known as a shell company or a blank check company. And fundamentally, you are giving trust on the sponsors. So you're raising really capital on the back of the quality of the sponsors. In terms of the acquisitions, clearly it's one can imagine the kind of the M&A activity that can follow on through the capital that is raised from SPACs. The M&A has to be done in a specified time period, typically 18 to 24 months. And the beauty is the shareholders from where capital is raised has a right to vote on favor of the acquisition or against the acquisition. In the event the shareholders doesn't vote for the business combination, the SPAC could need to be liquidated and the money returned back to the shareholders with interest. So that's the trust element of it in terms of how shareholders' money gets protected. Of course, in case the shareholders votes for the acquisition, the business combination gets approved, and then finally the targets gets taken over, what is called a de-SPAC. And you will obviously hear this a lot as we talk through this conversation. So de-SPACing of the target, that's what happens. Typically, when you do this acquisition, typically it is also followed on with a follow-on capital offering, which is called a PIPE transaction, as in private investment in a public equity situation. And finally, the SPAC kind of gets submerged with the new target company, and then the new company has a ticker symbol and starts getting traded in the capital market. So that's fundamentally some of the aspects of a SPAC. We'll look at into in terms of the kind of the volume of transactions that have happened in SPACs, and this is about the US capital markets. SPAC is not a new thing. It's been there for last 30 years. But if one looks at the trend, right, 2020 clearly was called the year of SPACs because $83 billion was raised from SPACs. And that contributed 50% of all the IPO that happened in the US. In 2021, in the first 3 months alone, $90 billion have been raised. So one can imagine close to $170 billion of money raised in the last 15 months. If you look at the number of SPACs, 248, 276 SPACs in 2021 alone in these 3 months, and 248 in 2020. And clearly, the average IPO size has been in the range of $300 plus million. If one moves forward in terms of some of the key market transactions that have happened in SPACs in the US, I think one key takeaway when I was looking at this is that out of the $170 billion of capital that has been raised, close to $135 billion is still sitting as dry powder to make acquisitions. And I feel that's a huge opportunity for Indian companies to kind of look at this opportunity in a very serious manner, because that's the dry powder of targets that is going to be merged with a SPAC. If one looks at sectors, very clearly, it's the high growth sectors, typically sectors like deep tech, electric vehicles, smart mobility, renewables, who are not just traditional companies, but who are building businesses for the future, new emerging businesses. But one looks at the overall sectoral composition in the last 2-3 years, it's been largely around TMT, consumer, and healthcare. And in my view, we are going to see this trend going forward as well. Some of the top transactions, clearly, there was Nikola Corporation, which merged with a SPAC at NASDAQ at a $3.3 billion valuation. There was Virgin Galactic, which merged with the famous SPAC by Social Capital at a $800 million valuation. And there was DraftKings, a digital gaming company, again a sector which is seeing tremendous growth, with a SPAC at NASDAQ at a $2.7 billion valuation. So some of the top deals, as you can see, are in these sectors. Moving forward, what does it mean for India? As I said, as I started, that in my view, with the announcement of ReNew Power, I guess it is real. It is not just fundamentals and theory and definitions and opportunity. It is real. But it's not a new thing for India. You've seen companies like Yatra, Videocon, and of course, India Hospitality, which was one of the first SPAC that got listed on the LSE in the hospitality industry way back in the 2007 days. So very clearly, if I want to sum it up from my perspective, is this is a absolute opportunity for India to look at an alternative area for capital raise and to get listed in the US or in the global markets. Clearly, sectors, the high growth sectors, are the ones which in my view has a prominence opportunity here. However, there are certain nuances. There are certain approvals and regulatory aspects that we will try to decipher for you. Implications of cross-border mergers, implications on tax, the RBI. How does that play? Can an Indian company with a significant resident shareholding, can that really de-SPAC? So I think some of the things that we will discuss through this August panel. Without much ado, I would like to bring in our beloved CEO Vishesh Chandiok. and member of the governing board at Grant Thornton Global, to give his views and in what direction do you see, Vishesh, really an opportunity for Indian corporate. Over to you, Vishesh.
Thank you very much, Raja. I've been called many things before by other people. I don't think beloved has been one of those. So thank you. I really appreciate hearing that from another partner. As CEO of a professional services firm, it's always good to hear those sort of words. First of all, a huge thank you to such an august panel to agree to join us at this Grant Thornton third webinar on the subject of overseas listings. This one focused squarely on this, really hot subject of SPACs, special purpose acquisition companies. And of course, a huge thank you to 600 plus people who decided to take out their Friday evening to hear about this, super interesting subject, I guess, at this time. As Raja said, 2018, 2019 had, about 50 SPACs going to market, raising capital in 2018, 2019, right? 50 each. In 2020, suddenly that number went up to 250. And in 2021, just in the first quarter, that number is at around 200, right? So you can see, the hockey stick with which, the popularity of SPACs as a route to go to market and raise capital is there. And of course, everybody's heard about the Renew Power story, fantastic story, and I'm delighted Mr. Muthukumaran is here to talk about that practical experience. I'll just go back to my own experience with SPACs, and it was 2006, I'd say, when I first heard about SPACs in the Indian context. It was a company called India Hospitality Corporation, which went to the UK markets and raised a $175 million SPAC. It was a gentleman called Ravi Deol, founder of Barista, who just done the Molson Coors transaction, close friend, who'd raised that SPAC along with a gentleman called Jason Ader. And they acquired Sky Gourmet Catering and Mars Restaurants. Those were the two businesses they de-SPACed. They sort of rolled into that $175 million SPAC, and grew out, built, and then sold again over time. I also heard about a second one after that on the US markets called India Globalization Capital, about $100 million, $90 million SPAC, which still exists, by the way. And then, of course, later there was the Videocon D2H, Yatra, and then in the more recent past, the biggest of them all, Renew Power. Raja talked about those three big stages, right? The SPAC IPO, the acquisition, roll-up of the targets, the so-called de-SPAC, and then the third stage, which is trading as a SPAC if the shareholders approve, and all the compliances, filing thereafter, right? Those are the three big stages, and I think that's quite clear. What I'd love to hear from the panel today is more detail around who can be a sponsor and actually go to the market and raise a SPAC, right? 200, as I said, in the first quarter itself. Can I go to the market and raise a SPAC and ask for money? What is a credible sponsor? What's the right size of target that goes into a SPAC? So if there is a $200 million SPAC, what is the right size of target or targets which would roll up? I read somewhere 3 to 5x, of the SPAC value is the rough band, but it would be good to get a perspective of the panel on that. Of course, everyone talked about this being a fantastic, opportunity to quickly raise capital, to quickly progress on the listing process. Of course, gain currency for global acquisitions, gain reputation as a global listed company. But the question that comes to my mind there is how quickly. So compared to a direct overseas listing, which would take you somewhere around 12 months, how quick could a SPAC process be from start to finish? So that's on speed. The second question that comes to my mind that would be great to get the experience of this August panel would be on costs of capital. So compared to the capital you raise, is it 5%, 10% of your capital? Is it more that you're spending in this entire process? Everyone talks about the higher valuations in overseas markets, particularly the US market. It'll be wonderful to hear from Vaibhav at Cantor Fitzgerald and others Rajiv, who has terrific experience of SPACs. How much higher is that valuation? And do these valuations actually hold post-listing? Is it only, you're seeking a higher valuation on day zero, but what's the experience after listing? In terms of who can actually list, of course, in India, an Indian listing is also an opportunity. And why did someone like Renew Power not consider an Indian listing? Early stage companies, many startups, those with a very different future to the past, that sort of similar hockey stick like SPACs. Will they be able to show projections? Can they still list if they don't have much of a profitable track record? Is the who that comes to mind. And then the other question that also comes to mind is the risks. Are there reputation risks instead of going for a direct listing when probably there'll be different kind of diligence through the IPO process? Is there a reputation risk associated with taking a shortcut and going down the SPAC route? And of course, since we live in India, nothing can be complete without the regulatory hurdles that one may have to go through, particularly for domestic investors when there's significant domestic investors. To hear from Sridhar R on the regulatory considerations, are Grant Thornton Bharat, transaction tax expert, as well as Siddharth Talwar, an expert on US GAAP, IFRS, and all the filings, the 8K, Super 8K as it's called, when a SPAC lists, and then subsequent 10K, 10Qs if you're a domestic, and 20Fs if you're a foreign filer. I'm sure Siddharth would talk about those. How complex is it to go from a Ind AS reporting framework or Indian GAAP reporting framework to those reporting frameworks? So I'm really excited. I really hope our August panel, as Raja called it, can bring out those practical aspects and nuances, because I would expect most of the 600 odd people will know the basics. Already, Raja, there was a question: can people get a copy of your presentation? There was also a podcast where you explained the 101 of SPACs, which is already available on social media, our website, and otherwise, I'm sure you can share this presentation. But what I really hope we can bring out from the panel today is those practical aspects and nuances to be careful of. So fantastic opportunity, as you said, Raja. If India can even get a slice, say a 10% slice of that dry powder that is sitting, it can really help fuel growth, fuel that job creation that new age companies can do, and that is so important to the growth of India. Really look forward to the next hour or so.
Thank you, Vishesh, very much. And just to take a cue from Vishesh, where he left is the significant dry powder that is available, and the opportunity that India Inc. and corporate has it in play. Really, I call it the M&A play in the next 18 to 24 months. So it's real. Now, I just want to kind of get into the panel discussion. As I said in the beginning, it's truly a privilege for me individually to be speaking and moderating this panel with so many experts globally, and I will introduce the panel. As you can see from a speaker lined up, what we've tried to do is really get the key drivers of a SPAC. And of course, the man of the moment, Mr. Muthukumaran, warm welcome to you, CFO of Renew Power. A very warm welcome, Mr. Muthukumaran, to this panel. Needs no introduction. So obviously, we'll share. It would be great to hear your experience on the practical nuances, as was Vishesh alluded to. We've also have Vaibhav Chadha, Managing Director of Cantor Fitzgerald. Vaibhav is joining from Hong Kong. And again, Vaibhav has and his firm has played a significant role from an investment banking perspective, and also sponsoring SPACs as well. So it'll be great to hear the aspects of the reality on the ground and the valuation considerations. We've also got TCM, Meenakshi Sundaram. Thank you again coming in, founder and MD, Chiratia Ventures, formerly called IDG Ventures, to give the private equity perspective. So many unicorns in India, who has the potential, held by private equity investors, and how are they kind of looking at this opportunity? Uh, uh, of course, Rajiv Khanna, warm welcome to you, Rajiv, joining from New York, partner Buchanan, Ingersoll and Rooney law firm. And Rajiv, will be great to hear from you again the legal aspects, but more importantly the practical aspects in terms of handling so many SPACs for a number of years. Of course, the person I may say we all are missing is Avinav. Avinav Bharti, can't make it today. He's unfortunately has got another commitment. Abhinav is available for questions and seek inputs later on as well. I'm missing you, Abhinav, on this panel today. And of course, my colleagues, Sean Denham. Sean is our SPAC leader of Grant Thornton US. Sean is joining from the US. And Sridhar R to talk about the tax aspects, on the structuring nuances. And finally, Siddharth Talwar, who leads our financial reporting and advisory practice, to talk about the accounting aspects of SPACs. With much ado, I will straight away get to the panel now. Request Sean to come in. Sean, I guess you got to put your video on and unmute yourself.
Can you hear me okay? It looks like
yes,
my video is on.
Yes,
so,
absolutely.
okay, great.
Yes.
So, Raja, thank you for inviting me. It's a pleasure to be here today. As you mentioned, you threw around some numbers on the number, really the rise of SPACs. Just to give that a little more perspective, in 2019, about 80% of all public offerings were through the traditional IPO, right? So 80% traditional, 20% SPAC. 2020 is about 50-50, and this year the expectation is it's going to be a complete flip to about 80 to 90% will be through a SPAC transaction, 10 to 20% through the traditional IPO. So really, what's changed? Some of the panelists will talk in more detail than I will. The rise of kind of the PIPE transaction has allowed these SPAC transactions to transact. And also the sponsor promote is new relatively new compared to 15, 20 years ago. You mentioned, why the popularity. I think any popularity starts when there's a legitimate organization or a legitimate company that kind of does it first. Again, these have been around forever. But, as you mentioned, the Virgin Galactic, the DraftKings really made these a viable and popular opportunity or vehicle as opposed to the traditional IPO. But also some really high net worth individuals, great investors in the US have popularized this. Bill Ackman of Pershing Square raised a $4 billion SPAC, which really, woke up the public markets to say, that, if Bill's doing it, if TPG, if all these large private equities are creating these vehicles, there's got to be some legitimacy to them. So I think that's really was a big catalyst for the SPAC transaction on the U.S. market. You mentioned a few of the industries that are really, really popular. E-vehicles is hot. I feel like if I created an e-vehicle company today, I might probably get a pretty good valuation in a few hours from now. But that's a really, really hot industry right now and popular around SPACs. Tech always is popular. You mentioned, I think, healthcare, energy is a huge SPAC target right now, but also ESG. So a lot of private equities that are creating or investing in sponsors right now are looking at ESG type entities, and crypto as well. Crypto has gained more footing, a little more legitimacy, and it feels like every few months there's a little more legitimacy to the crypto market as well. So those are a few of the industries. I'll talk really briefly about what are some of the benefits of the SPAC versus the traditional IPO. First off, the speed to market is definitely one of those. In the traditional IPO could take up to a year. And I think, through what we're seeing in the SPAC market, it can be anywhere from 3 months, 4 months, 6 months, can be a year. But for the most part, speed to market is important. But I think the most attractive thing to an operating company is really their ability to tell their story. So through a traditional IPO, as the regulations work, classically it's historical information, right? It's the audited financial statements, it's the historical information. Do you have a good track record of EBITDA? Under a SPAC transaction, more of the information is forward looking. So some of the earlier stage companies that traditionally would not go through the traditional IPO are seeing an opportunity to tell their stories to the market with the forward looking projections. And that is a really, really key distinguishment. As a result of that, the size of the companies that I think are approaching the SPAC market, it really runs the entire spectrum. You have the more mature companies that are just deciding, I think a SPAC makes more sense for me. One of our companies with Grant Thornton in the U.S. that went public through a SPAC back in August was Utz. Utz is a salty snack food company, cheese curls, potato chips, pretzels. I think my kids love their cheese curls, but so they decided, very mature company, 100-year family-owned business, and they decided to go through a SPAC transaction versus a traditional IPO. And the reason why they felt getting a mature sponsor to be a part of their organization was incredibly important to them. A sponsor that shared their vision of where the company was going. A strong sponsor management team was really, really important to them. And that marriage of the sponsor with the operating company and 1 + 1, they felt equaled 3, right? So really important on thinking through from an operating company, do they believe in my story? Do they believe in the vision? Can they be accretive to the management team and creating a really great board to help them think through where they want to go as an organization? So really important there. So that's probably some of the key benefits of the SPAC transaction. What I would say as if you're an operating company thinking through, what's important to me, what are the 5 things that I need to think about as I approach a possible SPAC transaction? And by the way, we're getting phone calls. I'm fielding probably a dozen phone calls a day in the US from companies that are pre-revenue to companies that are $1 billion in revenue. So even the pre-revenue. So we were the auditor for a company that was pre-revenue. They were in the e-vehicle space, didn't have their first dollar of revenue. They had a $250 million purchase order. And as a result, some sponsor groups approached them and said, hey, have you thought about going public? And instead of going through the traditional 4 or 5 different capital raises, so Series A through Series E through Series G, where some of these earlier stage companies are half their business is focused on running the business, running the operations, going into new markets, identifying those customers where they want to play. And the other half of their business is focused on the capital raise. So I think a lot of companies, even the earlier stage companies, are looking at the markets and saying, if I can pour $200 million of equity plus a pipe transaction into my business, so I can stop focusing on the capital raise aspect of my business. I can really focus on running my business and working with a great sponsor group. That's kind of attractive to me. So, I want to think about that. I think also a lot of, and I'm talking to a lot of these operating companies every day, sponsor groups are reaching out and, making phone calls into some operating companies and kind of catching them off guard saying, hey, we've created a sponsor. We're focused on your industry. We've got a great track record. We've got great experience. Would you consider going public? And a lot of these operating companies hadn't thought about that in the past. And so they're kind of waking up to it. And as you mentioned, Raja, there's probably about 400 plus SPACs right now looking for transactions. In the next couple of months, there'll be 500 and 600 SPACs that are looking for transactions companies. So the opportunity really, it's a new thing for the U.S. markets. Although SPACs have been around forever, But just, and I'll give you my final thoughts here and I'll turn it back to you, Raja. But some of the things, if you are an operating company, that I think you need to think about. Really, your first call is to either an attorney or to a bank. The banks are really operating as the conduit between the sponsors, the sponsor groups, the SPACs, and the operating companies. So, all the banks have a list of all those SPACs that are looking for targets. They probably even know a lot of the ones that are going through an S1 right now that aren't quite public yet. But they're categorizing those by industry for the part. Talking to a really good law firm that has done this before, that can guide you through the transaction. Also, on the U.S. markets, I'll talk specifically for a U.S. company. The high majority, almost all operating companies are going to be under AICPA standards. You would need to upgrade your audit up to PCAOB standards. So if you've had an audit done, you still would need to have a re-audit done to upgrade to those standards. But I think the most critical thing for an operating company to think about: are you ready to be a public company? Huge difference being a private company and being a public company. Do you have the right management team? Do you have the appropriate board and corporate governance structure? What does your internal controls structure look like? You really need to get IPO ready. And there's a lot that kind of goes under that. And that management team experience, the right sponsor group, is critically important. So I could talk as well for hours on this, but I won't, Raja. I know we've got a great panel, and I'll flip it back to you.
Thank you, Sean. I think it was great. I think you really created the opening very nicely for all of us. I think I obviously don't want to summarize, but I guess 2-3 key points that I took out from you was clearly lots of benefits of timing. But I really loved your comment around the sponsor and the operating company combination. It's not 1 + 1 = 2, but it's much more than that. So the ability to really identify the right sponsor and the management team, which has the experience to really take you not only through this listing opportunity, but also create value for the opco. So I think that's a great significant difference as opposed to a direct listing. So I think that's something at least a big takeaway from me. I think you also touched upon a very important point, is the ability to tell a story. The projections part of it. In a direct listing, you don't have the opportunity to really tell the story fully, but you have the opportunity to tell a story. And your I guess the EV idea is solid electric vehicle. I'm sure people are hearing about that. But if I may just come to you before I come to my next panel speaker, is you also talked about risk, the preparation part. And I guess there is a little bit of question sometimes on SPACs. Is that a legitimate question? Are we talking about the quality of the founders, or do you think this is going to stay, or is it just a 2020 phenomenon? Initial thoughts would be good to just throw direction to the next speakers.
Yeah, there's a lot of people that have spoken, and my crystal ball is just as cloudy, I think, as anyone else's crystal ball. But I do think it's a legitimate vehicle, especially with the PIPE investors that are now part of the transactions. I think that legitimizes the valuation. Investors are putting faith in that. I mean, the SEC is going to come in, even as recent as yesterday or 2 days ago, the SEC came out and made some inquiries into some investment banks on kind of their quality controls. How are they validating some of these sponsors? So, the SEC is going to have a very loud voice in this. Last Friday, I will tell you that 10 SPACs were expected to be priced for the first time. 7 of those SPACs were not priced, so they didn't get a pricing. 3 were priced below 10. The other 3 were priced below 10. So, is that an indication of a softening of the SPAC market? It could be. I've talked to a tremendous amount of iBanks just in the last week, and they don't necessarily believe that's an indicator because, it's supply and demand. There's so many SPACs out there now, which is a great opportunity for operating companies, by the way. But the volume of SPACs that are out there currently, if there's too many, I think the value naturally goes down a bit. But a lot of people are wondering, will these 500 SPACs find deals, or will they, return their money to investors? I personally believe they're going to find the deals. I mean, if you just look at the private equity transactions to other PEs, that middle market is really is having the loud voice in the SPACs, where classically the markets have not been open to those type of lower middle market to middle market companies. The traditional IPOs have been kind of the larger companies historically. This is an opportunity really for that middle market, as opposed to selling private equity to private equity or private equity strategic. It's now really become a viable third option. So I do think that these sponsor or these SPACs that have filed or have their effective S1, I do think they're going to find it. I predict, just my prediction, that the ones that find transactions, right, the sponsor groups that find transactions will do SPAC 2, SPAC 3, SPAC 4, and have had, once they have those track records, you're going to see this continuing. The sponsor groups that do not have great transactions, they won't do SPAC 2, SPAC 3, SPAC 4. So I think you're going to see that hit the markets over the next 24 months, Raja.
Fantastic. I think you laid the direction very clear. It's absolutely legitimate. It's viable. But you also talked about the SEC coming into play. So it's obviously, one has to watch it, how it flows, but it is real. It's a very viable option. With that, I guess I will turn to my next panelist. Pleasure to invite you, and warm welcome to Mr. Muthukumaran. Again, the man of the moment. First of all, congratulations on the announcement. Obviously, everybody is waiting to hear from you. But I guess my question to you first would be, obviously India's leading renewable energy company. You had various options, India direct listing, but you've announced for SPACs. But it'll be great to walk us through the thought process that you had, that what led you to choose SPAC, and of course cover what it means from an Indian corporate perspective. Over to you, Mr. Muthukumaran.
Thank you, Raja. First of all, it's a pleasure to be here, and I see there are 300 odd participants in this room right now. And I was just eyeballing the list of participants, and I see that they're all from different parts of the world. I will try and sort of confine myself to what we have experienced. I'm very happy to share, my view on some of the questions that you may have as we go forward, in order to make your, sort of panel efficient. That said, actually, let me answer your point in a little longish way. Your question is, why did we choose SPAC and what is the context to it? For those who do not know about ReNew, very quickly, we are a decade-old company. We are the leading renewable IPP in India. We operate around 5.5 gigawatt, and we have another 4.5 gigawatt in the contracted capacity pipeline. So that takes us to a 10 gigawatt in a couple of years from now. So that's the final growth that we have seen. And the company was built in 10 years from scratch to where we are today. And we have today $6 billion of capital employed on the ground. Out of that, about $1.5 billion is actually raised from private equity over the years. The first one was a decade ago, Goldman Sachs, with $200 million check. In some sense, that is also a blank check, but it's a private investment and a private equity. And over the years, we have raised equity capital from many different investors. ADIA from sort of Abu Dhabi. We have Canadian Pension Fund. We have JERA. We also had ADB, the Asian Development Bank. So we have gone through many diligence. Plus, in the $6 billion, $1.5 billion was equity, and the balance 4.5 is roughly the debt. Now, our debt book also comprises of domestic finance, NBFC, project finance, from banking, non-banking, sector financiers, multilateral lending agencies. And also the one I want to highlight in this context is actually the bond issuance that we have done. We are the largest number of bond issuers out of this sector in India. So the point I'm trying to say is that we are used to many rounds of diligence, and we are also used to international investors. And that, I think, was a very strong foundation on which we were aspiring to become a listed company. And to take your question straight now on, it's been a 10-year-old company with the latest investor coming in a few years ago. So it was time for us to actually list the company in the natural evolution. While we were actually, sort of evaluating various options, we were very sure that we wanted to do listing. And, we preferred to go to US listing. And let me try and answer one question that you might have as to why, US. For us, actually, given our profile, we are already a very strong EBITDA company. We could very well have actually listed in a couple of markets, UK, US, India. All of them are real options for us. We actually eventually chose US for positive reasons, which is basically US, the way we looked at it is that is the strongest pool of deep capital on ESG, which is an evolving trend. And that directly plays to what we do in the business. So therefore, we eventually landed in US. And, we actually chose SPAC. While we are on the way to list, we were actually anyway preparing for the listing. So for us, actually, this question is slightly different. For us, the question of SPAC versus IPO came in, as we were well into the process of listing. We did not have to evaluate this because we were actually pursuing the path of listing in any case. And as we were into the process, we had done a lot of work in listing preparation. That's pretty much applicable to SPAC because, in my mind, I'll talk about the differences as we go forward, as I see it. But, in my mind, it's exactly the same process, whether you do a listing in US or whether you do through SPAC or through traditional listing. When we were actually into the process, we came across, SPAC. We got introduced to, and then actually it snowballed into the real option. And the bottom line, I would like to highlight what Sean covered in his actually, notes is number one, we like the sponsor. And number two, we could use projection. And number three, it was a difference in timing. Now, let me start in the reverse order as to why timing. I don't think, sorry, you wanted to ask some questions. Am I going with a different flow than what you have?
No, absolutely. Perfect. Absolutely go. Yeah.
Okay, great. So timing for us is not actually cutting short the process. I don't think SPACs cut short the process. It's exactly the same process that you would go through for US. It's just that the order is different. If you especially have a pipe into the product, basically, sponsor of SPAC and the SPAC shareholders vote at the end of the, sort of transaction. And I'm assuming that people are, familiar with the SPAC process in the interest of time. But pipe process actually gets committed upfront. So, and in our deal configuration, that was important because, our deal is sized with $855 million of pipe capital and $345 million of sponsor capital. So, a SPAC helped us to actually close the, pipe product sooner than later. And nothing changes in terms of scrutiny, in terms of process. There is no shortcut. There is no avoiding any part of the process, for an IPO. The second point that I told you is actually, projections. And, we are already a company that have actually achieved the kind of the growth that we have, that I sort of spoke in brief. But, the future also looks a very high growth trajectory. And in a high growth trajectory, if you are able to actually present projections, the investors get an incremental comfort because they are able to study the projections that you put out there, and they're able to actually decide the comfort on whether, they are going to be okay or not going to be okay to underwrite this, valuation. And the third is actually the first I mentioned in that order is a sponsor. The team that we got had an excellent combination of both operational experience in power as a sector And also some people there also had a tremendous experience in capital markets in US. So, this combination was very potent, and, we were very, keen on taking that forward. And, from SPAC point of view, they were very keen for all the reasons that I mentioned to you in terms of our deal configuration. And also the company background and the growth that it already achieved. And extremely important, the governance. Sean spoke about it. And let me actually now go to slightly a different level, and try to lay out in in simple words how I see SPAC.
Sure.
There are three stakeholders in a SPAC, right? The first one is company. Let me start with the company because I'm part of the issuer. The second stakeholder is actually the pipe investor, and the third is a sponsor. The way I look at issuer angle is basically this is no different from IPO, but a few years ahead of IPO. You don't need to be fully prepared for IPO, which is not the case in our example. We were prepared for an IPO, but typically SPAC is used by companies as a route. If they are about to be ready for an IPO, but not exactly there. That is why the sponsor, the projections, all those things help, right? So you're a little earlier in the life cycle of the company. But you should be ready for international capital. Again, I told our story that we were already ready with, all the ingredients required for international IPO. But, I just said it in a statement, but it takes years to prepare, and Sean highlighted it sufficiently. So I would like to underscore that's an extremely important aspect from issuer point of view. You should be ready with governance. We just say it in one word, but it takes a lot to prepare. Whether it is board or internal controls, various things, accounting, business strategy, the team, various things that go into governance.
Certainly.
The perspective that I want to talk about in terms of investor, which is actually the pipe investor, the way I look at it is actually it's a portfolio management for them, wherein this product gives an ability to expose themselves to a company which is slightly earlier on in the IPO. Therefore, they are ready to take the risk for the reward that it will come. A private equity investor catches a lot of upside, and when it comes to IPO, while there are still juice left, but substantial part is actually played out. So this is an opportunity for actually a public investor to participate in a private equity. That's why it's called actually also private investment in the public equity, right? The third is the sponsor, an extremely important component, because that's how the product is configured, wherein there is an endorsement by another set of people, by a thorough due diligence, as well as the industry experience they bring in, as well as the operational expertise that they bring in. Typically, the sponsor is somebody who a set of people who have run the businesses. So they know what it takes to build a successful business. And if they are able to actually give a stamp of approval, then it means a serious lock, sort of to the issuer company. So, combination of these three, gives actually an opportunity for a win-win situation. I mean, this is a case where once you list, the game is not over. On the contrary, actually the life starts as a new avatar. So, it's extremely important that we actually configure a win-win product, in this case. And let me go now very quickly, if I have 3 minutes to, sorry, how am I doing on speed?
Absolutely fine. Please go ahead.
Absolutely. Okay, so with that background as a product for Indian companies, let me tell you, there are a lot of things that one need to work on. Preparation takes a long period of time. But two aspects that I want to highlight is whether you are ready to be an offshore company. And number two, what is your tax implication? Whether you are ready to go through the tax impact of it. Let me talk about both of them. You need, in simple terms, a company that needs to be listed in NASDAQ or an NYCI. That can't be an Indian company. So therefore, you need to have a company. And American bourses are actually quite mature. You could be an American incorporated company, or you could be anywhere else in the world. If you're anywhere else in the world, you could qualify for a foreign private issuer. And if you're sort of American domiciled, then you could actually be a domestic issuer. The laws are different, but fundamentally there is no different as a product for the issuer. It's the same thing. Because Indian company cannot be listed outside India under the Indian regulation, you need to actually have a company that is incorporated outside India. You choose the venue, again, a lot of things goes in choosing that venue, number one. Number two, unless you are already an overseas consolidated holding company that can be listed, you need to actually offshore the company or externalize the shareholding. I'm trying to make it very simple. It's a deep subject. I'm sure Sridhar will touch on a lot of aspects of this. I
Yes.
do not see a tax exempt transaction. So therefore, unless you already are an overseas consolidated holding company, if you are trying to externalize for the purpose of this transaction, then it will be a taxable transaction. So either you are prepared to pay the tax on one extreme, or actually, you're tax exempt, or the investments is new enough that value created is not high enough, right? Therefore the tax is not high enough. But fundamentally, you need to eschew the tax impact that comes along with it. A lot of other issues: where do you put the board, who will come on the board, what is the governance structure, what are the indirect tax implication, what are the PE implication, POEM implication going forward, where will the services lie, where will the management lie, a number of questions that come up, as you can actually imagine. Then let me go to the next subject quickly on cost benefit, because that was another question that you raised. And I also saw one of the panelists ask the question, what is the cost? Is it as high as 50%? Is it 5%, 10%? It's north of 10%. It's more like 15%. This sounds very prohibitive, right? But the reality is you do a cost benefit analysis for any commercial deal, and this is no different. So you actually do a cost benefit analysis. And unlike a product contract where you can actually determine what is the final price, the price here is a valuation that you get. Now, you really need to make up your mind, and it's really your decision whether actually, the valuation difference that you're getting is worth the cost that you're paying. If you just look at it on a standalone basis, it looks high, but any cost is high. Even 3% could be high, 5% could be high, 10% is high. You need to look at it in a context. But the cost itself is going to be, much north of 10%. It could be even 15%. But is it worth it? Yes, it is worth it if you actually perceive that you have an access to a different pool of capital, and you're actually going to be a listed company, so you have continued access to capital, and few years ahead of your time. So to that extent, are you willing to pay that cost? Yes, I mean you need to evaluate and come to a conclusion. Two things that I want to say and finish so that I don't sort of take too much of time is, number one, what is the timeline? Like I said, our case is probably not the typical case, and is not probably the true example that you will go through, because we had already done a lot of preparatory work, but we had done door-to-door pricing of the transaction in 2 months. We started in late December, and we announced the deal in February. But in a whole transaction cycle, this is only one part, right? Which is the PIPE announcement. There is 6 months of pre-work that we have done, and there is going to be 4 months of post-work to even close the transaction. So, door to door, if you look at it, it's years, but it's a year's work, but it's no different from, even private equity today can actually take, if you're very lucky, 3 months, sometimes even it can take 1 year.
Sure.
So I don't see this to be any, different, in terms of, any IPO issuance. And the last part is reporting. We as a company, we're prepared for all the reasons that I mentioned to you. But, if you are a domestic issuer, you need to be US GAAP for NASDAQ and NYSE. but it all depends. I mean, you can do SPAC even in Europe if you would like to, although bulk of the deal happens typically in US. You really need to look at the requirements of the stock exchange in the country where you're actually going to be listing. If you're a US listed company and you're a US domiciled company, then you need a US GAAP, but we are a FPI. We could even pick IFRS the way I understand, but clearly for us, IFRS is enough. And be ready for IFRS, but not actually fully doing IFRS. Before this transaction, we were doing parts of IFRS, but yeah, we needed to do IFRS to do this transaction. And these are the two things that I want to highlight. And like I said, the deal is not over. We have finished the pipe pricing. That is a committed capital. We will go through the SEC scrutiny, which is no different for an IPO. And once SEC clears our file, we will then have to actually do the shareholders meeting of the SPAC, and then we close it. I think I've said a lot, and probably have taken a little more than what you wanted, Raja. And ask me any questions if you want. Otherwise, I'll hand it back to you in terms of giving it to, passing it on to the other panelists.
Well, thank you so very much. I think you've absolutely not only covered a lot, but I think you set the context very well. Not only well, I would say you said it very clearly. So many aspects, and I guess at least to me, what it stood out very, very clearly. You said it's the same process like any other US listing. So the robustness, the preparation, the governance, the way you look at your business is the same. So it's not a quick process. So I think that was at least for me, it was very clear. I think you really touched upon a lot of aspects around the tax and the offshoring, given the restrictions on direct overseas listing, the need for offshoring, and as you mentioned, it's not tax neutral. There is a tax cost. But again, I think again something that stood out very clearly: the cost versus benefit, right? It's 10% high. Is it 15% high? But is it high compared to the value that you get? So clearly, the value aspect, at least for me, was pretty clear. And of course, the scrutiny part, right? I think some obviously people are saying it's excellent, but I think some of the at least audience had a question around, is a lot going to be scrutiny? But I think you've cleared it very clearly that you got to do all the tests, right? It is not a shortcut, so you got to be fully prepared for that. And I think on the tax aspects, Sridhar R, obviously my colleague would cover that. And this was extremely valuable, I'm sure, for our listeners, and I'm sure we will come back to you.
Sorry,
moving
Raja,
ahead. Yes, please.
1 minute, if you don't mind.
Please. Absolutely.
Yeah. So, the only other aspect I was actually, wanting to say, and I didn't actually, sort of underscore, is, eventually this is a form of capital raise, right? I mean, in a continuum of business cycle and business, sort of life of a company, you start with, let's say, own capital, then you bring in VC, then you bring in private equity, and then you bring in, SPAC now, and then you do a listing, and then you go back to, sort of this thing. So, SPAC is just a means to an end. It's a form of capital raise. It's a form of listing. And, it really depends on where your business is, whether you are ready to take, international capital, and whether you're ready to stand scrutiny by, sort of US or whichever exchange that you choose, that exchange's scrutiny. So eventually, the starting point is actually what is your business and where does this fit in your capital raising? You've got to do many things to build a successful business, and capital raising is one important element. And, so this is what it is. I mean, this is not an end in itself.
Well, loved your comment on that. It is about the solid business fundamental. It's just a means to the end. I guess I'm sure audience is listening. So key is the business over here. And I guess Vishesh wants to come in. Over to you, Vishesh, for your comments.
Raja, I just wanted to remind you there's exactly half an hour to go, and we'll have to quickly rotate the speakers.
Yeah.
Perhaps
of course.
Yeah, so just if you could quickly do that. I think there's a great
Of course.
question there.
Yeah.
For who is a direct listing better than a SPAC route? From Yogesh Mathur, I wanted to bring a quick answer on that, perhaps, and maybe some of the panelists can touch on it also. Maybe if you are not looking for a sponsor, right? If you're not looking for that management team to come and help you, and you have all the ingredients yourself, would be it is something that comes to mind. But maybe somebody wants to take that question later. Go ahead, Raja.
Yeah, Mr. Muthukuram, do you want to come in or any? Yeah. You're on mute.
Have I unmuted? Yeah.
Yes, yes.
Okay,
Absolutely.
so the question is, do you need sponsor, right? That's a question.
No, sir, the question is, for who is it better to choose a direct overseas listing route versus a SPAC route?
Okay, so the way I look at it is, if your company is about to be ready for IPO and not exactly ready for IPO, you're just a couple of years ahead of it, it'll be good, because then you're able to show projections and you're able to get a stamp of approval from sponsor. So it's typically the case. And like you mentioned, that particular aspect may not be fully true for us. We may be ready, but typically that's the way I look at, sort of SPAC capital.
Sure. Perfect. Thank you for that. Yeah, I guess, I'll come to Rajiv in a while, if it's okay, Rajiv. Just want to go with the flow. I'll bring in Vaibhav now, Vaibhav Chadha, Managing Director, Cantor Fitzgerald. Obviously, you've looked at SPACs pretty closely from a investment banking perspective. Just walk us through what does it mean from a valuation, and your perspectives around this.
Look, I think for the purpose of this conversation, we're talking about the Indian companies. And again, we're not talking about raising a SPAC, because so far we've been talking about a D-SPAC and not a SPAC per se. So from a D-SPAC perspective, when you look at the Indian canvas, I would say that, in our opinion, rather in my opinion, I don't think that the SPAC as a product is relevant for every sector. So first, we need to rule out a few things. Given the scale of the capital raise in US, and this year they're expected to be about 500 plus issuances. So the system itself has not been geared up for that size. So if you're a company which is valued less than $1 billion, it's going to be very hard for you to get attention in the US market. So that's point one. So I'm just trying to rule out certain kind of enterprises. I'm not saying that it's not possible, but just from from this at this point of time, how things look. So if you are valued above $1 billion, and that market in India is growing, I read the other day that NASSCOM predicts there are going to be about 50 unicorns in India by the end of this year. So a lot of these businesses are businesses which are designed not just specifically for local markets. These are very global, scalable businesses. And as pointed out earlier, for businesses like those, where you see that having a sponsor guide you in an overseas market can really build your business further, I think a SPAC is the right product compared to direct listing, because then you are on your own. In this case, you have to think of it more as an M&A trade, where you're merging into a firm which is run by sponsors who understand that particular market better than you do. And therefore, that can really help you to expand your business. And then, that will also further bump up your valuations, because then you will have a bigger market to address and so on. We all know that, in the Indian ecosystem, the tech market is, there are many issuances which are looking to get priced in the local markets. So that sector has a lot of specific nuances. You need to reach a certain scale before you become EBITDA positive. As regulations stand in India, for example, you need to have a certain amount of profitability before you can go to the IPO market. let's say if you have above 15 crores of profit over the last 3 out of 5 years, then you can attract 35% of retail investors. Otherwise, it's limited to 10%. So there are challenges for especially the tech business models to raise capital from public markets. I think in specifically those instances, US market provides much more depth, because you're looking at businesses who understand, investors who understand those sectors. So that's in those areas, it's a clear winner. Not that other traditional businesses can't go to US markets, but I'm highlighting the advantages, in specifically these sectors. And then currently the market has a lot of liquidity in US. So, you clearly get the benefit out of that. As pointed earlier, in this case, you have the benefit of sharing your forward-looking statements, which you can't do in a typical IPO process. So here, for the Wallcross investors, you can share your forward-looking projections, and that can be quite useful, for you to determine exactly what's your price. Because in traditional IPOs, you have to maybe wait till right in the end to get to understand what kind of valuations you can get. I think it would be worthwhile for me to just drill down a little bit about the process, exactly how it happens. So, it starts with you first maybe hiring a banker who prepares the materials for you, which is similar to any other issuances, which will take kind of about between 4 to 6 weeks, preparing financial models, a data room, presentations, and then you start outreach to tier 1 SPACs. SPACs have specific mandates of sectors, geographies. So when you then drill down to your sector, you're able to identify, call it, let's say in the first round, about 30 SPACs who you think are relevant for you. So you start with outreach to those SPACs. Out of those, the goal is first to receive a letter of intent from the most relevant ones. So typically we see that in this current market, from the outreach, the letter of intents take less than 2 weeks. So in 2 weeks, you get kind of, who are the people who are relevant, in talking to you. Then the next stage is you basically negotiate from the letter of intents. Who do you are most comfortable with, in terms of who you want to shortlist. Then, this is where, experience of a banker will be handy, who's dealt with the process and has experience with those sponsors. So let's say you identify that a counterparty is the one I have selected. So you will have to then get into an exclusivity period. This is the period where post the LOI, that particular SPAC will undergo more deeper diligence, legal, financial diligence, which could take anywhere between 4 to 6 weeks. So during this exclusivity period itself, one will also reach out to the PIPE investors. The goal will be to get the PIPE investors also ready at the same time as the SPAC doing the diligence. So, you will, at this point, you will Wallcross investors to figure out what they think about the business, the valuations. And, the goal is to announce definitive agreement and PIPE together, at which time the deal will be public. And then, your SEC review and starts during the public marketing period. So that's broadly the process, which could take anywhere between 20 to 24 weeks. I'm not touching here about, the specific local approvals that may be required. In the case of India, if the entity is an onshore entity, it may require RBI approvals. And as touched upon earlier, there are taxation challenges. So there are ways to, simplify that. But at the moment, only entities which are incorporated offshore or where the capital is sitting offshore are best suited. So yeah, I'm just trying to drill down, that it's not for everyone. And there are, of course, risks involved. You have to also think about, once you have listed, how does your stock perform later? So you need to also bear in mind that you need to have a certain set of bankers who are covering you from a research perspective, so that there is enough liquidity in the market post-listing, so your stock continues to perform even post-listing. Yeah.
Oh, perfect. I guess you absolutely articulated that. That was a question in the Q&A. Is there a minimum size? And you talked about giving a guidance that minimum 1 billion valuation is possibly a minimum to kind of look at a SPAC, and of course clearly articulated the role of investment banker, the timelines. You talked about 24 weeks. And I love the comment about sustainability of stock performance post-listing, because it's a journey. It's not just that you end by a listing. And of course your point on covering the stock, and that's where you need the coverage very specifically. Thanks, Vaibhav, for that. Of course, now I'll bring in Rajiv Khanna. I think Rajiv, US market law is king, if I may say. Vishesh posed a question on litigations. There's projections over here. Just walk us through how serious is the litigation angle, and how should Indian companies look at this clearly? Is it more riskier from a direct listing? And talk us through that, please.
So, for the longest time, everybody believed that if you put projections, then you will invite litigation. The surprising part has been that SPACs have invited less litigation than normal IPOs. I was running through the numbers the other day, but basically the litigation risk on SPACs mergers has been about 1/4 of a normal IPO. So I don't see the litigation. Obviously, that doesn't mean you put projections which are pie in the sky. And frankly, a good investment banker will not let you, like Vaibhav won't let you do that, because there's reputation risk to them also, plus a liability risk to them also. But the fact that the projections are put has not shown statistically to have increased the litigation risk. This has been already covered, but let me try to give 3 examples of why you want to look at SPACs to merge with, as opposed to doing a direct IPO, as whether it's in India or a direct listing outside. And Mr. Muthukumar rightly pointed out, both are actually just a capital raising events.
Absolutely.
And the 3 reasons that come to my mind are valuation, and valuation. Let me give you 3 examples of that. We talked about Virgin Galactic. Virgin Galactic is going to take all of us someday for a journey of the space. How many space journeys have they done? 0. How many are they going to do next year? 0. And I think somebody mentioned the valuation that they merged at 800 million. In a traditional IPO, where all you can talk about is historical facts being you have no space shuttle ready to go anytime soon, you have no revenue, forget about net profit or EBITDA. You have nothing, you have a plan. That's what gets you the valuation, because you can put your projections up front. I'll give you example number 2, Fisker. It's an EV company which has merged into a SPAC. How many cars have they produced? 0. Do they have a blueprint for how they're going to produce a car? Not exactly. It's in process. And you can look at its valuation. Example 3, QuantumScape, run by a Sikh gentleman out of California. I bought the stock at 42, it reached 54. I thought, this is great, let me sell it. Why? He's going to produce batteries, the new age batteries. How many batteries has he produced? 0. What has he shown as the date when he'll get the first battery into the market? Not known. So SPACs effectively, in my mind, allow a public venture capital to happen, which is absolutely impossible to happen in an IPO. Because in an IPO, you can give no projections, you can give historicals, but none of these companies have any historicals. In fact, if you look at the SPAC mergers that has happened, I think Mr. Muthukumar's company is an exception, a good exception, that has been in existence for 10 years and actually has a real business. But that's more the exception than the reality in the SPAC mergers that I have seen, or at least it's a 50-50 at it. Somebody in the audience said, how would you then value a company which is pre-revenue? For a SPAC, you follow a future discounted cash flow model. I'm just doing it for another company. They have prepared a model. They have an EV vehicle I will not name, but they have one prototype ready. And now I'm shopping them with bankers, and they have produced a future discounted cash flow models. If we had 40 million, this is what we could do with it. This is the number of EV vehicles we could produce. This would be the revenue. So it's a future discounted cash flow model that is used to value these companies. Let me touch briefly on cost. The cost of merging with the SPAC can be from as little as 5% to as much as Mr. Muthukumar pointed out, 15% or more. That sounds like an awfully high number to start with. But is it really a high number to start with? If you did an IPO in the US, then the underwriters want 7%. And then guess what they do? They don't tell you the valuation at which they'll take you public. They take you through the SEC process, to the red hearing, through the road shows, and the night before, they tell you that what valuation you'll go on. Now you've already spent pretty much 6 months of your life going through the process. So technically, yes, you could walk away from the deal at that point and say, I don't like this valuation. Really, how many people are going to walk away from the deal? So that's why you see an IPO like Snowflake's, it doubles the day after it opens. So what did the investment underwriter do? The underwriter basically undersold the company at 50% valuation, sold the stock at 50% valuation to their preferred institutional investors, who then immediately turned around and sold the stock. You know, if I can buy a stock for $100 and sell it the same day for 200, I have to be a moron not to do that. So basically, they give a big freebie to their institutional investors. So now you have 7% underwriting fee, plus the big freebie that was given to the institutional investors. Does that add to 15%? Does that add to 25%? Does that add to 30%? I don't know. I haven't done the math. But to my mind, it's an absolute myth to say that at least a traditional IPO in the US is cheaper than a merger with a SPAC. And of course, the SPAC mergers have other benefits, such as speed to market. I think speed to market, ability to sell your projections, those are the two big features. Now, SPAC is not for everybody. If you are a traditional company growing to 5 to 6% a year, I would say SPAC is not for you. I mean, you have healthy margins, they're growing at a healthy rate. That's not the SPAC. You're not a candidate for SPAC. You should do a traditional IPO because you have historical projection numbers to sell, and you are nobody buying your stock at $10 believes that it's going to be $100 in a couple of years. You have no dream to sell. You have a good, solid investment to sell, as you should sell it in the traditional way.
Perfect.
Let me talk about a little bit about the challenges, I think the earlier speakers, Mr. Muthukumar, the Jeff Weber, and others mentioned it about Indian companies. Now, obviously, if you are so lucky as to have already been offshored, then you're golden, you have no issues. And if you're so lucky as to have a majority of your investor base, shareholder base coming out of the grandfathered Mauritius companies or from other jurisdictions, obviously you do not have a tax issue that will loom on you. But if you are not that lucky, or not quite that lucky, and you're a traditional Indian company with a traditional Indian shareholder base, you do have a tax issue, because India, unlike the US, does not allow a tax-free exchange. You do have a round-tripping issue, because now you'll be investing into a US SPAC. If you exchange your shares, even if you pay the tax, you are you'll be investing into a US company that goes back to investing into an Indian company. And you guys should know that better than I do. I always find this round tripping regulations to be extremely ridiculous, but they are there, and we have to live with that. So what do we suggest in that case to some of the companies we are talking to? We are suggesting that sorry about that. We are suggesting that we have a provision in the dark. We effectively structure the transaction as an FDI, and that was done in Videocon and some of the other transactions, where the SPAC effectively invests into the Indian company. And then we top it with that as effectively as a FDI, and we top it with that with the provision that the Indian shareholders can at any time, in a defined ratio, exchange their Indian shares for the shares of the SPAC. Now that gets over the tax issue, because the Indian shareholder is not going to exchange their shares for a SPAC shares until they're ready to sell it, in which case they'll pay the Indian tax, which they'll have to pay anyway, and then sell the shares of the SPAC. Doesn't get over the round tripping issue, which we hope the Indian government would relax over time as SPACs get more popular. But it still effectively gives a market value to the shares of the Indian company, because now I can say, exchange my share of the Indian company for a share of the SPAC, which is valued 1 for 1, let's say. So if the SPAC share is valued at 100, my share is technically valued at 100.
Rajiv, if I may come in, if it's okay with you, just conscious of time, I think we will have to extend this by another 10 minutes. I'm just conscious of the other panelists to come in. And I know Sridhar will cover a little bit on the tax aspects. And I know that's a big thing, but if you allow me to go to TCM, is that fine?
Yeah, absolutely. I'm sorry.
No, not at all. We're absolutely on the floor.
Out of my time. It's a topic that you can go on for the couple of days.
Absolutely.
So please, I'll stop here now.
Thank you, Rajiv, for the understanding. And I guess for the audience, I think we will extend this by another 10 minutes. I just want to make sure that we will not be able to take all the Q&A, but I guess you're seeing the kind of perspective. Straight to TCM, right? You've been the PE investor, you've seen it all, so many unicorns. Just give us a little reality check on ground. Is there real action where you see unicorns really looking at SPAC seriously?
Yeah, thanks, Raja. I think from the investor in a unlisted company, especially the tech space, there are a few perspectives that we look at it. One of them is actually the stage of the company and the timing, right? Like Rajiv was saying, when do you want to go listing? Are you going to sell a future dream and then want to go listing so early or not. The other part is also there is a huge question about how long is the company ready to go public? And I'm not talking about from the maturity of the company, but actually from the point of view of pressures of being listed, right? Then you get onto a quarterly treadmill, right? And you get worried about what any comment that any analyst would be making, whether how it is affecting the price. Is the company ready at a steady state, or it is still rapidly growing where it has to take some bold bets and is worried about how the public markets will react to those bold bets? That is one of the key concerns. And also there's a lot of money that is sloshing around in private markets. That's why you see even Indian companies have reached 16 billion, 15 billion valuations are still not listing, not even talking about listing, right? And so that gives a lot of freedom for the entrepreneur to go aggressively behind the market, to grow and not be under pressure from public market. So this is the first consideration. Are you ready to get listed? The second is which market is right for listing, right? And there are, obviously we talked about jurisdiction being one of the very, very important things, Indian company going direct listing elsewhere versus actually are you already outside, right? The second important thing is also about which markets are your customers based, whether it is consumer or if it's an enterprise side. It's about if you are an Indian consumer focused company, then are you better off actually listing here versus elsewhere, right? Obviously, there are other considerations which come in terms of, in India, it is very difficult to list a company which is not profitable, right? Not regulatorily, theoretically, actually, even a business plan can be taken public in India so long as you get a QIP subscription. But it's also the fact that it is not that easy, right? By the time there's SEBI reviews and things like that take place, right? So whereas international markets are very comfortable to look at it from a perspective saying that, look, I see the opportunity, I see the growth rate, I see that eventually at steady state it can be better. The other is actually comparable companies. Are there enough comparable companies in the markets in which you want to list? So if you want to take a company public, the e-commerce in India, right, versus you take a company public in, let's say, NASDAQ, it's a very big difference, right? So you will get value based on your metrics, and because there is enough and more comparables that are available, right? And one of the important things I think somebody alluded to is, what are the FDA regulations with respect to Indian business, right? Is that going to be, other than issues like round tripping and other thing, is it also restricted? Like a retail company cannot go public in US market, which will be seen as actually a FDI by the parent into the Indian company. So is it possible to do that or not? That is one more consideration that needs to be seen. Once the market decision is taken, are you India or are you outside? Then the question comes to saying that, do you want to go traditional listing or do you want to go SPAC listing? Okay. There are benefits and there are, otherwise I think others have covered it, so I'm not going to repeat myself to that. But most of the tech companies which are growing dramatically fast, ability to give future projection definitely helps, right? But actually one of the key challenges in that is in terms of, do you want to raise money in terms for the company's business, or is it only a question of companies throwing up a lot of money, doesn't need to raise capital, but only it's a question of listing to enable liquidity for the investors? Then the cost factor becomes a big issue, because investor for the same business is actually giving away a portion of the company, portion of the value to the SPAC vehicle, right? If there is a large pipe deal, then the cost of transaction comes down, because anyway for fundraising you would have diluted. If it is not fundraising, then the big challenge for the existing investors who plan to sell, it becomes a clear overhead. For a founder, it may not, because for founder is not planning to sell at that point in time, or even if he takes a small liquidity, it's a very small amount. I think that's another big hurdle that people have to cross, right? So if you do not have a need for a lot of capital to be raised, which third is also the pipe, right? The whole issue of actually tying up the pipe, that is a risk that somebody takes when going through the SPAC route. Similar to actually the traditional IPO route, where you do not know how you will get priced, but in this case, you also do not know whether you are going to get the subscription that you need. What happens if the subscription amount is less than what you want, right? So those are some of the considerations. In addition to that, there are others like OM and others come in, but I am conscious of time, so I want to stop here. And when we have time, we will manage more questions.
Sure. Well, thank you, TCM, for that. You obviously brought a very different perspective of why list. So that question, and you brought a very different perspective to that. I'll quickly move to my colleagues, again, conscious of time, Sridhar and Siddharth Talwar. I just want to make sure that, we will run some podcast around this topic. It's a detailed topic, and you will see our podcast released, detail on tax and accounting. I want to request Sridhar and Sid to come in here, just what the top 3 things that one needs to keep in mind for tax. I think obviously we talked a lot about tax, but maybe Sridhar, very precisely, top 3 things, and is there a way out for companies looking at SPAC listings from India?
Thank you, Raja. It's a pleasure to be participating in this conversation. And like my predecessors, there's quite a bit that has been spoken around tax and regulatory challenges. If you look at tax,
and if I may come in, Sridhar, 2 minutes.
Raja.
Apologies for that, but
yes. Raja, I'll say that the regulatory challenges that are kind of posed in India are particularly more challenging than tax. Tax is a consequence, and if you are early into the structure, you are able to kind of plan for it. But and I'm not saying that there is no tax event. There will be a tax event most likely, unless, like some of my predecessors said, that you have a grandfathered investment from a tax treaty country, or whether if you are an AIF or a special purpose vehicle which has got a tax exemption regime in India to do that. So I would kind of want to focus on the regulatory side first and then come to tax very quickly. I think the biggest challenge, and Rajiv Channa has asked a question on if the company is owned over 50% by Indian investors, how do you, and there's no externalization yet to be done, what do you recommend for SPACs for such a kind of situation? RBI obviously has been averse to a structure that has a resident owner of a foreign entity that in turn owns an Indian entity. In other words, what is known as an ODI, FDI structure. There are very limited ways to overcome this restriction, and it is recommended that an inverted foreign entity is set up at an early stage of the business and well before any de-SPACing transaction is contemplated. And this should ideally kind of result in non-residents owning a majority of the Indian target. And therefore, there is only very limited flexibility that exists to offer resident promoters with options, ESOPs or otherwise, which allow such residents to mirror the value at which the SPAC is being traded as compared to what they will get in an exit situation. But the majority has to be held through the SPAC, and to that extent, there will be a limited cash exit as well as a potential swap. And there again, you see that a swap again is there is an overhang of the regulatory element where a swap is not again under the automatic route, and therefore RBI will be averse to any such possibility. Now coming to the realistic possibility, again, resident investors wanting to participate in the SPAC or the de-SPAC entity have a very limited window under the LRS route that exists today. The current cap, as you know, is set at USD $250,000 per financial year for such investors to participate, and that's a limited window which can be considered. But again, this is for a cash deal and not a swap in that example. A resident wanting to swap his share in the Indian target for shares of the DSPAC entity is a significant hurdle with an RBI approval requirement, which may not be forthcoming unless there is a policy change that the government considers. And this has a larger issue, as you know, of moving towards a full capital account convertibility regime that actually needs deeper government thought and intervention. And just to give you a sense that as the current regulatory norms stand, a direct SPAC listing in India is still a very early concept stage and therefore is not a choice for us at this stage. There are, however, active discussions that the government is undertaking to consider the IFSC GIFT City regime as the front runner to consider and allow such a structure. SEBI has also set up an expert group to examine the feasibility of an Indian SPAC. And when I say Indian SPAC, what it means is an Indian company being able to list in US directly. And in a sense, what it means is an overseas direct listing of an Indian company. And like I said, it's a huge tectonic shift in the way exchange control law looks at this, where a full capital account convertibility regime is what is expected. So it would be a foreign currency share of an Indian company that we are talking of. And if you see the depth of that, it's a fairly tectonic move. Now coming to tax, obviously tax and death are inevitable, and that pretty much aptly summarizes the position today. A transfer, whether through a swap or for cash of the Indian target shares with the SPAC shares, is a capital gains event, and the shareholder will end up paying tax on any gain that is made in the exchange or sale. Given that the SPAC targets are likely to be in high growth or innovative sectors, there is an interplay of tax with exchange control law in India that expects a fair value assessment for such swap for resident shareholders, and this becomes a significant challenge. Treaty protection, like I said, is available for foreign investors who invest early through Mauritius or other routes, or for resident investors who hold special status as AIFs, etc. But one thing to watch out for is the underlying book value of the Indian target as well, particularly in the situation where a resident shareholder has to get shares of the SPAC or the foreign entity free of cost. And this is a window which is potentially available for us to consider, which may be regulatory compliant and tax efficient if it was an early stage. Given the extraterritorial reach of Indian income tax law, an indirect transfer of an Indian asset also results in a tax event for the SPAC shareholder, both resident and non-resident. And therefore, this is accentuated in an event where the Indian asset contributes significantly to the overall value of the SPAC entity. Indian tax law does provide an exemption for this mischief if two foreign companies were to merge in a tax neutral manner. And this would be important to plan for, as the investors may not be entitled to treaty protection in such a situation. Other issues from a tax perspective that need to be kept in mind are ring fencing of potential exposure around, like TVM mentioned, the place of effective management for the DSPAC entity being in India. Tax implications on revenue upstreaming of the returns from the target in India in the form of dividend or interest should also be taken into account while deciding the jurisdiction of the DSPAC entity. At the target level, there is always a need to protect carry forward of losses or MAT credit while undertaking the transaction. And obviously tax considerations in the US as well as other countries from where the investors pipe or otherwise are located are coming through is also needing a detailed evaluation. In summary, I would say a lot of planning needs to be done for a DSPAC or a SPAC transaction. And happy to take any specific questions, Raja.
No, thanks, Sridhar, a lot. I think it's very clearly articulated. As I said, tax regulatory very key, and we will run this going forward. And quickly coming to Sid now, accounting, right? IFRS, US GAAP. very quick comments on, top 2-3 highlights you would like to bring to our audience.
Sure, Raja. I'm cognizant of time, so I'll quickly
Yes.
wrap this up in 2 minutes.
Yes.
I think 2 critical milestones, and some of the earlier speakers have already talked of that, S4 or F4 filing, which is the proxy statement on which the shareholders are going to vote on the transaction. And the next milestone is when the deal gets signed, within 4 days of that, you file the Super 8K or the Super 20F. But essentially what they do contain from a financial reporting point of view is the target's historical financial statement, the OpCo's financial statements. So what's relevant here for you, for you to understand is what status would the company be? There are terms like smaller reporting companies or emerging growth companies, or which have a direct impact on how much information you're going to present in the financial statements, whether it's going to be 2 years or 3 years. 3 years the general rule, 2 years more of an exception. There are a lot of age-related aspects also. I'm sorry. Whether you're filing within 45 days of the year end or not, and all of that needs to be taken into account. That will add more information into your filing. I think the most critical question that we've been asked often is around whether it's US GAAP or IFRS. Honestly, there is the question is quite interpretational. It a lot depends on what the eventual status of the post-merger registrant going to be. If the US domiciled SPAC, most likely you will end up with US GAAP, both for your definitely for the purpose of your Super 8K. For the purpose of S4, which is the proxy statement, you could still go with IFRS, but I don't think I would advise you if you were to eventually file US GAAP in your Super 8K. If you get a foreign domiciled SPAC, you may still end up becoming a US domestic registrant, depending upon how and what kind of pipe investors eventually participate in what shareholding the existing shareholders get. But you could still get away with doing IFRS, which, as Mr. Muthukumaran mentioned, is almost the same as India's. Quickly speaking, few things that you need to bear in mind is there is the reverse business combination accounting is complex. There are specific rules around financial instruments which are very different from India's. There are the presentation requirements of Regulation SX. They also add to complexity. And the last but not the least, your audit is going to be conducted under a much more stricter regime, which is PCAOB, and the auditors may need to hopefully not, but perhaps redo the entire audit to comply with those standards. So all of that added on is a fairly long process. So while I'm positioned at the end to talk about it, I think more about that in our podcast. Thanks, Raja. Back to you.
Thank you, Sid. A lot to cover from an accounting perspective. I think that's really what we had for all of you. I think we run 15 minutes late, as you can imagine, the kind of extent over here. I guess clearly we will share all the materials to the participants, to the audience. We've taken note of the questions. We will run some FAQs in terms of what we can clarify. But as Grant Thornton as a group, we are ready here and now for you to walk you through this process. I think top 2-3 things, at least I take away before I end, is one is its preparation, right? It's you got to prepare. It's not a shortcut process. It is as important as any listing. Second, as Mr. Muthukumaran said, business is critical, right? That's the fundamental on which you're doing this. And third is the regulatory angle, right? As you heard from Sridhar, of course, various speakers, Rajiv, Vaibhav, the regulatory is really an important angle over here, the offshoring angle, the domestic angle. But as a group, we believe this is a real opportunity, and Indian corporates should be thinking about it, evaluating this, and is not just, if I may say, a fry in the pan. This is real, and we will stay engaged with all of you. It's a pleasure to present this to you, and we will run this series and look forward to having all of you on a Friday evening from all of us. Vishesh, any closing comments on a quick thing from you? Otherwise, if the last word from you, Vishesh.
No, I think I can't. I would say that was an extremely comprehensive panel. I always learn from these events. I'm
Yeah, I think we lost Vishesh for a bit. Yeah, so we'll just allow if he comes in. Otherwise, yeah. So I guess we will conclude this. Thank you very, very much. Yeah, I think Vishesh is back. Vishesh, are you back? Yeah, Vishesh is back. You're on mute, Vishesh. Yeah.
Yeah, Raja, sorry, my network fell, but I said, I really want to thank everybody for joining this conversation. And as I said, we will run some of the tax, regulatory, accounting aspects in podcasts, as well as share, the different presentations that were prepared with everybody. For me, the summary of this all, and I'm sure TCM will not agree, and many others would, perhaps also have a different perspective, is what Rajiv said, and I think Mr. Muthukumar also said that this was in some ways, a public venture capital coming to the fore. And you can see how, earlier private equity investors go to LPs and raise a pot of capital and then take a 2% management fee, a 20% share of carry. I know Alok Mishra, my friend from General Atlantic's on, and many private equity folks are on. They would perhaps, now be considering, should we look at raising our own SPACs? The other, thought that came to mind there was earlier, a lot of companies.
Yeah, I think Vishesh has. Yeah, we'll just see if he can come back for a second. Yeah. Okay, we'll just wait for.
Raja, my apologies. The network's a bit unstable. But
yes.
Thank you very much. Have a lovely weekend, everyone. Really appreciate all the panel for making time. Thank you.
Thank you very much, all of you. Have a great day. Have a great weekend. Thank you.